The Fed just cut rates by 50 basis points. How do stocks react when the Fed cuts rates? Here is what history tells us. Let's go over the recession from 1970 to 1982. Now, obviously, it wasn't a full recession that entire time, but there were recessions between, and the markets were kind of tricky. Now, 3 Fed chairmen in that time. The starting Fed fund rate was 4.25%, and the starting GDP growth was 3.3%. Unemployment was 6%. Inflation was 4.4%. Now, the worst contraction was in 1981 at a minus 2%, and the worst unemployment rate was 10.82%. Now, the story of cuts and raises. From 1970 to 1982, rates were raised 43 different times and lowered 22 times. Rates started at 42%. Rates were first cut in February of 1971 to 3.75%, and the Fed continued to raise rates and lower rates for 8 years, all the way to 20%, 3 times, and back down to a low of 3.75%. Now, what's the S&P data? At the start of 1970, January 2nd, 1970, the S&P started at 90.31. The valuation low of 1982 was 102. So in that span of 12 and a half years, from January of 1970 to August of 1982, the S&P was only up 12%. With inflation during that time, you absolutely got crushed. Now, the biggest percentage drops in the S&P from 70 to 82 was in 1970, the high was 94, hit a low of 68. 1971, a high of 105, a low of 89. 1972, a high of 120, a low of 101. Guys, a lot of volatility. Big jumps, big drops. You can see from this logarithmic chart. Now, log charts don't show the parabolic rise, but you can see from 1970 to 1982, even with a log chart, we're flat right here. That's incredible. Valuations started much higher, ended much lower. In fact, in 1982, this was the all-time low of valuations. Right now, the stock market GDP ratio is 110% overvalued. Back in 1982, it was 68% undervalued. If you'd invested money in 1982 in the stock market, for the next 10 years, you would have made well into mid-double-digit returns, not including dividends. That's an incredible return. Why? Because the less you pay, the more you make. Now, in 1990 recession, the catalyst there was the savings and loan crisis. Here's all the stuff here. Guys, the Fed fund rate was still coming down from the early 80s. 8.5%. GDP growth was a paltry 1.9%. Unemployment rate, though, very good, 5.4%. Inflation, though, a little bit higher than they wanted, 4.8%. Okay. Now, the worst GDP contraction was basically the same, and the worst unemployment rate only got to 6.3%. This ain't bad, guys. All of these numbers, none of these are bad, really horrible, just high Fed funds rate and GDP growth about steady. Rates started in 1991 at 8.5% before being cut 4 times down to 6.75% by the end of the market downturn. Now, what's the S&P data for that time? Well, let's check it out right here on the logarithmic chart before I go through. But you have 1990 right here. I mean, it was still in an up. We were still coming off this big growth from 1982, right? So it was still growing significantly. The low, the value on June 5th of 1990 was 368. The value at the low in 1990 was 295. That's a 20.1% drop in 1 year. Imagine how individual stocks did. Individual stocks tend to have more volatility than the S&P 500 as a whole. Now, in 2000 to 2003, we had just come off of a booming market in the late 90s. The only time we had a surplus because tax receipts were so much higher because we were growing so fast. The tech boom led to so much growth. Starting Fed funds rate was 5.75. GDP growth, solid, 4.1%, coming off 8.3% during the late 90s. Unemployment rate, this was the low basically until recently. Inflation, 3.5%, and worst GDP was actually 1%. Still growth on there. Worst unemployment rate, 6.3%. But remember, we were coming from 3.9 going to 6.3. That was a big drop. And in that time, the S&P 500 was awful. This rate cutting was also coupled with valuations, though. Because remember, the S&P 500 valuation in 2000, March of 2000, and more importantly, the NASDAQ was insanely high. In fact, the NASDAQ ended up falling 83% from the March 2000 high down to the 2003 low. The S&P 500 high was 1552 and hit a low July 24th of 2002 of 775. And I don't think we actually even started our next bull market until around June of 2003, if memory serves me correctly. That's a 50% drop. 50% for the S&P, and like I said, 83% drop for the tech-heavy and very high valuation NASDAQ. Now, I don't want to draw too many parallels to today, but it seems to be pretty reminiscent of those times. We have very high-flying tech stocks with very high valuations. It was the only time in history, I believe, where we had 3 years in a row of S&P 500 falling since the 1957 start of the S&P. In fact, look at this. On a logarithmic chart, from 2000 peak, it took until roughly 2014 to equate to that level again. 14, 15 years of flat growth. From the great financial crisis of 2007, 2009, guys, this was a doozy. Banks were shutting down. Mortgages were basically non-existent for people. I remember buying real estate and being told by banks in 2008, 2009, 2010, and 11, we are not going to lend for you if you're trying to buy an apartment building in the Midwest unless you put half down. That was crazy. We had Ben Bernanke, who was a history buff, loved talking about the Great Depression. His biggest fear was being responsible for the second Great Depression. He was all about that. 4.75 rate cut. Starting GDP growth was 2%. Unemployment rate was 5%. Inflation 2.8%. Worst unemployment hit 10% during that time. Now, in 2007 to 2009, the story of cuts starting at 4.75 in the summer of 2007, rates were cut 10 times in a row to boost the economy with no rate raises, nor did they remain flat, and ending 2008 at 0.25% before cutting to zero and leaving rates there from 2008 to 2015, even though the recession ended in June of 2009. It was an explosion of the Fed balance sheet. We had 0% rates. It was an incredible, incredible event, and it boosted the economy for a very long time. The question is, was the economy boosted on fundamentals or based on cheap money? October 11, 2007, the S&P hit a high of 1576. Remember, at the 2000 peak, it was like 1550. The low, March 6th of 2009, 666. That was a 57.7% drop. Similar to 2000 to 2003, the market essentially went straight down for 2 years before beginning to rebound in March and April of 2009. Now, from there, we had an economic boom for the ages. We had a stock market boom for the ages. Remember, 666. The lower stocks go, the better the following boom. The higher stocks are, the worse the future. Whether it's going to go down, sideways, whatever it is, please get that into your head. Paying more is not good. Paying less is better, especially for market indices like the S&P 500 or the NASDAQ. Guys, the COVID recession 2019-2020, look at this sexy beast right here. Jerome Powell, the guy who said, I'm not going to be intimidated by the President of the United States to cut rates. And guess what? He was intimidated by the President of the United States to cut rates. In this time, Fed fund rates was 2.25%, GDP was 2.3%, unemployment 3.5%, and inflation was a paltry 1.9%, but we got to a worse unemployment of 14.8%. For the entire year of 2020, it was a 3.5% GDP drop. But in one quarter, in the second quarter, because of COVID, we had a minus 35% drop in GDP. It was a massive, massive drop. We shut down the entire U.S. economy. Valuations were very high. And the S&P was at 3,337. 2 months later, hit a low of 2,191. It was insane. Every single day, 5, 6, 7% drops, 7% rebounds. It was absolutely nuts. 34% drop over 2 months, followed by an instantaneous recovery stimulated by the cutting of rates back to zero and printing of trillions and trillions of dollars. People were allowed to stay home because the government was just going to pay them $600 a week. Starting in August 2019, rates were at 2.25%. They were cut 4 times in a row from 2.25% to zero by April of 2020. They remained through March of 2022 when rates were raised from 0 to 0.5%. Inflation came in at over 8% and reached a 40-year high therein. Cutting rates is a temporary solution and temporary medicine. The real cause was the economy slowing down and spurring the Fed to cut rates. Shutting down the economy in 2020, all the other slowdowns was what caused the Fed to cut rates. Where the recession started, was it right before or right after? The point was when they felt the sickness, They cut rates as a way of putting temporary medicine in there. Now, our goal on this channel is to teach everybody to invest for the long haul, whether it's long-term ETFs that are low cost or individual companies. We don't want you to feel the pressure to sell, because when you have the pressure to sell, you're not going to sell at good prices. You would have crushed it if you bought stocks during any of the periods of time when stocks fell. Your goal is not to panic sell. We want you to be the believer of buying stocks as they fall and holding on to winners as they recover. Yes, temporarily your stocks will go down, but if you buy good companies or the entire index as they fall, you're getting a better deal. You're buying more cash flow for less money. Even if the cash flow is temporarily smaller because of a recession. Even a company like Apple, that was absolutely incredible. This is the COVID crash. It was down 28% from February 15th to March 21st of that month of COVID. You're telling me that Apple was worth 28% less because of a temporary shutdown? But the fear was we didn't know when we were going to open back up again. Look at another extreme. When Meta fell to $88 on November 4th of 2022. But who held on? I'll tell you somebody who held on. Mark Zuckerberg. Jeff Bezos, after his stock fell 95%, said, here's our stock falling 95%, but I looked at all our fundamental metrics of the business and they all got better. What's the lesson there? The lesson there is that the market's going to react the way they're going to react, driven by people's emotions. The question is, are you a buyer of a business? Are you a buyer of the U.S. economy? If you are, and you pay reasonable prices, you will do well in the long run. The stock market is undefeated over decades and decades. The way you lose money is looking at it short term. And you need to change your way of looking if you think of it in short-term spots. We're trying to teach everybody that when you buy a stock, you're buying a piece of a business. And that's why buying stocks should be a difficult decision, because you're investing in a business for a long run. Now, as the market falls, you're going to need to be here and be part of our community. The reason being is that emotion gets everybody. I don't care who you are. It's easy to make good investment decisions for 5 or 10 years when markets only go up. And that's all we've had for the last 5 or 10 years. But it just takes a few days, a few months, a few weeks, few quarters of emotional turmoil to turn you into a forced seller and alter your financial future. This is why we encourage you to join the community before that day comes. Reprogram yourself. It took reprogramming for myself, and I still do it constantly. And history tells us that it's not a matter of if, it's a matter of when. So what I want you to do is, I want you to click on the link in the description below, or go to everythingmoney.com/signup, $7 for 7 days, join our community, get all of these tools before we take them away, because we're splitting these off into individual packets very soon. So if you want all of them forever, you got to join now. And even better, if you join now, you're going to be stuck in your pricing tier forever. So go do it, change the way in which you think about money, and be surrounded by thousands of like-minded people that can help you navigate the tough times. Now, if you guys want to watch a video on 20 stocks I'm looking to buy during a market correction, watch this next video. Thank you for your time.